All right, welcome everyone. In the world of business, it's really tempting to think of numbers as, well, as simple objective truth. Profit is profit, a cost is a cost. End of story. But honestly, it's not quite that simple. Every single number a company generates is actually telling a story. And that story is always, and I mean always, being told for a very specific audience. Understanding who you're talking to, well, that is the first, and I'd argue the most critical step in making any good business decision.
So let's just jump right in with that fundamental question. Who is this story for? Is it for the people who are actually on the ship, steering it day to day, making those split-second operational choices? Or is it for the people standing back on the shore? We're talking investors, bankers, potential partners, the ones who are trying to decide if they should risk their hard-earned money on this ship's voyage. Believe me, the answer to that question changes absolutely everything about how numbers are collected, presented, and understood.
Okay, so let's get into it. If you take one thing away from our discussion today, let it be this. The single most important distinction in all of business analysis is this great divide, the split between internal and external users of accounting information. And this isn't just some minor detail in a textbook. No. This is the core organizing principle of the entire field. It's the bedrock.
Now this lays it out perfectly. On one side, you have your internal users. Think of them as the captain and crew on the bridge of the ship. Their goal is simple, to run the business. They need real-time, messy, super detailed data so they can make immediate course corrections. This is the world of managerial accounting. It's all about looking forward, being flexible, and crafting strategy. But then, you've got your external users. They're not on the ship at all. They're watching from the safety of the harbor. Their goal? To evaluate the business. They don't need to know what the engine's RPMs are in real time. They need standardized historical data to judge how the whole voyage went and decide if they want to buy a ticket for the next one. And that is the world of financial accounting. It's backward-looking, very rigid, and built for one thing: comparison.
So, let's step onto that captain's bridge first, shall we? We're going to explore the world of those internal users, the people inside the company, using financial data to make the thousands of little decisions that keep the whole operation chugging along. This is the home turf of managerial accounting.
Now, on this ship, we're really talking about two main groups of internal users. First up, you have the managers. Think of them as the officers on the bridge, making all the big strategic and tactical calls. And then you have the employees, the crew, right? They're in the engine room, they're on the deck, and their jobs depend on those decisions and, of course, on the ship staying afloat. And even though they're both internal, what they need to know is actually quite different, so let's break that down. For a manager, accounting isn't about history class. It's all about what's happening right now and what's going to happen next week. They need data that's immediate, that's specific, and often, it's not even about money. A production manager, for example, doesn't just need the final cost of a product. They need to know things like machine downtime in hours, the defect rate per 1,000 units, the overtime hours this week. You're never going to see that stuff on a glossy annual report, but it is absolutely vital for controlling costs and running the business effectively today.
Yeah, put yourself in that manager's chair for a minute. The questions hitting your desk are fast and furious. Do we have enough cash for payroll? Now, you're not looking at the big, formal statement of cash flows that an investor sees. No way. You're looking at a down and dirty internal cash budget, a forecast that's tracking every dollar coming in and out, maybe even daily. Should we bump up the marketing budget? To answer that, you'd use a tool like cost volume profit analysis, or you'd whip up a pro forma budget to see what the potential payoff might be. These are internal tools for internal decisions. Is this department hitting its targets? This requires real-time data, maybe a variance analysis that compares what you plan to spend versus what you actually spent. The data has to be tailored to answer these very specific operational questions.
Okay, now let's shift gears and think about the employees. They're internal users too, but they've got a whole different set of concerns. They're not the ones steering the ship, but their livelihoods are completely tied with success. So they're looking at whatever financial information they can get to get a sense of the company's health, which for them translates directly into their own financial security.
Think about the perspective here. Unlike a manager who's in the driver's seat, an employee's questions are deeply personal. They're using this information to make huge life decisions. Is this company even going to be around in 5 years? Will the profits I'm hearing about actually turn into a raise? And is the company stable enough to fund my retirement? It's an internal perspective for sure, but it's focused on personal stability and the company's long-term health. And this is a perfect example of that internal mindset. A manager might look at the numbers and decide, yeah, let's cut some costs on Project X so our department can hit its quarterly target. It's a decision based on immediate needs and internal goals. And from the captain's bridge, that decision makes a ton of sense, right? But just hold that thought.
All right, so with that internal decision fresh in our minds, let's leave the bridge. We're stepping off the ship entirely, and we're now standing on the docks. We're looking at the company from the outside in. And out here, the information people need is completely different. External users could not care less about daily operational targets. They're making huge decisions about where to put their money. Welcome to the world of financial accounting.
See what happened? Remember that manager's smart decision to cut costs on Project X to meet a deadline? From the harbor, the question is totally different. It's not, did they meet the deadline? It's, wait a minute. By cutting those costs, did they compromise quality? Did they slow down innovation? Did they just make this company a riskier place to invest my money for the long haul? The exact same action seen through a completely different lens.
So, who are these people on the harbor? Well, for our purposes, we're going to focus on these three main groups. You've got investors, who give the company money in exchange for ownership and a piece of the profits. You've got creditors, who lend money and, of course, expect to be paid back with interest. And then you have tax authorities, the government agencies that make sure the company pays its fair share.
The main job of an investor is to put their capital to work effectively. So they pore over a company's published financial statements. That's the income statement, which shows profit over time. The balance sheet, which is like a snapshot of what the company owns and owes, and the statement of cash flows, which tracks how cash moves around. These three documents, which have to be prepared according to very strict rules, are the foundation of their entire analysis.
This is the multi-million-dollar question for an investor. And to answer it, they need one thing above all else: comparability. They need to be able to compare company A to company B. And that, right there, is why we have a critical system of rules called Generally Accepted Accounting Principles, or GAAP. The best way to think about GAAP is as the official rulebook for business, a universal language. It makes sure that when Ford reports revenue, it means the same thing as when General Motors reports revenue. Without that rulebook, investing would be the Wild West. GAAP creates that level playing field for everyone.
Now, creditors, like a bank, have a very different mindset. They're not dreaming about spectacular growth. They are obsessing over downside risk. Their number one goal is getting their money back, plus interest. So when they look at financial statements, they're looking for two key things: liquidity, which is just the ability to pay your short-term bills, and solvency, which is the ability to handle your long-term debt. Basically, can you survive this month, and can you also survive the next 10 years?
A creditor's whole process is about minimizing risk. So they ask, does this company generate enough cash to make its loan payments? They're going to live in that statement of cash flows. How much debt do they already have on the books? They'll calculate key financial ratios, like the debt-to-equity ratio, to see how much the company relies on borrowed money, or the current ratio, to check on its short-term health. These numbers give them a standardized snapshot of financial risk.
And last but not least, you have tax authorities, like the IRS. Now, their interest isn't in your growth potential or your risk profile. Their interest is purely in compliance. They need financial records that follow a very specific set of laws, the tax code. And this leads to a really fascinating point that trips a lot of students up. A company can legally have one set of books for investors that's designed to look as profitable as possible under GAAP, and a completely different set of books for the IRS that is designed to legally minimize the amount of tax it owes. Both are correct, but they are prepared for two different audiences with two completely different goals.
So you see what we have here? We've got these two distinct worlds, the internal world on the ship and the external world on the harbor. The key to being a successful business leader or analyst or entrepreneur is recognizing that you have to be fluent in both of these financial languages. You need to know how to talk about operational efficiency inside the company, and you also have to know how to talk about standardized performance to the outside world.
And this brings us to one of the most important lessons you can learn. It's about using the right tool for the right job. You wouldn't use a telescope to perform surgery, and you wouldn't use a scalpel to navigate the stars, right? Well, in the same way, trying to use a high-level external financial report to manage day-to-day operations, that's a recipe for disaster. And showing raw, unaudited internal data to an investor, that's an even bigger mistake. So I want to give you a simple but really powerful framework that will help you for the rest of your career. Before you even look at a number, before you open a spreadsheet, just stop and ask yourself these three questions. Number one, who is my audience? Are they inside or outside the company? Number two, what is their fundamental question? Are they trying to run the business or are they trying to evaluate it? And number three, based on that, how do I need to shape the data to tell the most useful and relevant story possible? At the end of the day, this is the most critical lesson of all. In accounting, the audience is never an afterthought. The audience is the starting point. It's the North Star that dictates everything that follows: what data you collect, how you analyze it, and how you present it. It determines the rules, the format, and the ultimate meaning of the numbers themselves.
And I'll leave you with a final thought to wrestle with, because this is where all this theory slams into the messy reality of business. What happens when these two worlds collide? What happens when a decision that looks absolutely brilliant from the captain's bridge, like our example of cutting costs to hit a deadline, makes the ship look unstable and risky to all those important people watching from the harbor? Figuring out how to manage that tension? Well, that's the true art of financial leadership.